Good morning, afternoon, evening. Welcome to this on-demand session of GTR UK. I'm Sean Edwards. I'm chair of the International Trade and Forfeiting Association and head of legal at Sumitomo Mitsui Banking Corporation. I've got a great panel today to talk about supply chain. We're going to look at how it's done during the pandemic, a couple of the really hot, the hot issues at the moment, the hot button issues. And then we're going to look to the future. I think all of this is positive, even the complicated stuff is being worked out. So first to introduce my panelists, Chris Roos from Greensill, Tim Nicole from Prima Dollar, Margrith Lutschg from Octet, and last but not least, Matthias Heck from Moody's, who is the author of a lot of papers in this area. So let's start off firstly with what sort of crisis we've been having. And I think for supply chain, it hasn't been a crisis. It's actually been a really positive experience and good performance. So, but let me start with Chris, because at Greensill, you've really gone into them. I mean, this is your bread and butter. This is your lifeblood. How's COVID-19 been for you, Chris, at Greensill?
Yeah, thank you very much. It's been very positive, I must say. And I think almost the first point to recognise when we're looking at sort of supply chain and working capital is actually the amount that is currently undertaken compared to the overall amount locked in the system. And maybe Matthias can comment a bit more, but a recent Moody's report came out saying that there was $55 trillion worth of addressable markets in locked in working capital, and only a very small fraction of that has actually been addressed. So as we come into this year, obviously the pandemic and COVID, is it a surprise that we've seen a big increase in the demand for SCF and other working capital solutions? Probably not, but there's also still a very long way to go. I mean, what we have seen from our experience is being a fintech, our ability to actually get cash into the real economy has generated a surge well over 100% in demand from our clients this year. We've seen a number of dynamic discounting programs being converted to supply chain finance programs, i.e. where the corporates are stopping using their own money to fund the supply chain and moving it to preserve liquidity and going out and getting external funders, which has also been a big driver in the market. Again, preservation of cash, capital is obviously a very big thing, a topic for all of our clients. One of the other things that we do, and we're seeing a lot more going forward, is using data science and AI to address the long tail of supply chain. And this is something that we feel is very, very key. A lot of the traditional models around supply chain had focused very much on the big corporates, the big suppliers, who are probably, certainly at the moment, not those who most need to have access to liquidity and financing. So in the current environment, that is key. But I'd say one of the key things that we have really seen is the increase is driven far more than just by liquidity pressures, but by clients looking after their suppliers. And there's been a really fundamental shift in attitude. We've got a lot of our buyers who are not just looking at supply chain finance because it's the right thing to do and paying on time, because they've recognized the robustness of the supplier-buyer relationship now needs to be stronger than ever. It's not just their own financial health that treasurers and CFOs are focusing on, but very much that they're concerned about that financial health of their suppliers as well. Giving an example, recently we had a large auto client of ours who had traditionally thought of supply chain as effectively an input cost, and they were doing what they could and thinking about how to minimize those costs and benefit themselves. However, during the pandemic, they've certainly realized that the bigger threat to their production was actually the robustness of receiving the components so they could actually build the cars. They totally changed their view to payment terms and the value that supply chain finance provides. So we've seen that both from a liquidity point of view and a change in recognition of what's important and the ecosystem in which corporates are all operating at the moment. And we're also now finding new ways of supporting the buyers and suppliers, again, using predictive AI. We are undertaking with all of the pharmacies in the UK, working with the NHS, where we are actually paying the pharmacies before the doctors have even written the associated prescriptions. So it's almost moving that supply chain even further into the future. making sure that the cash actually comes down to those participants in the real economy who most need it. So in summary, we've got what's happened traditionally, what's happening now, what can happen in the future. It's all looking very positive. They're the real fundamental benefits, and certainly at Greensill, we're very much in favour of that mindset shift towards SCF being a value-added tool and supporting the real economy, as opposed to it being driven to extend payment terms for the benefit of the buyer.
Okay, thanks, Chris. I mean, resilience of the supply chain, of course, in the current environment that we're in is even more crucial than it's been. If I understand you correctly, the Greensill experience has been that this sort of the fabled long tail, this bogeyman in supply chain finance, is really being tackled at last, and in part by using AI, which, as you know, is not without its controversial aspects.
Well, it's AI and data science. So data science more leading that as well. So you can actually have a look at real-time data, as opposed to a look back on a historical annual report and assessing the value of the client. We can look at the historical relationships that buyer and supplier have had, the quality of product that's been supplied, the timeliness of payment, and you can make judgments based on that actual live data, as opposed to, I said, historical point in time. I mean, we have seen programs traditionally going from sort of 50 to 60 suppliers when we've taken them over, where we've ended up with between 3,500 and 5,500 suppliers on that same program. So right. It's not, it really is actually happening as well.
Okay, well, that's really good to know. I mean, when we talk about supply chains, of course, in COVID, there's been a little bit more of a re-onshoring, but the supply chain is global, it is international, and the long tail often is in the emerging markets. And Tim, at Primadollar, that's where you began life as a company, and you've evolved. But tell us about your experience and how Primadollar is evolving, how the market's changed, how it's held up or not. What's been your experience?
Yes, thank you, Sean. And great to hear from you, Chris, about the things Greensill's doing, actually, which we also support very much. So we have built and launched the world's first supply chain trade finance platform, and this is a platform, a technology and financial engineering environment. So it's a combination of tech and structure, which enables large corporates to have all the benefits and ease of use and convenience of a supply chain finance program, but all the functionality and scope of traditional banking, trade finance products. So this is a merger of the world that you know very well, Sean, in your part-time, not in your day job perhaps, but in your other role as chairman, which is the traditional banking world of trade finance products, the LC, and getting payment at shipment to exporting suppliers. And we've taken all of the functionality and scope of those traditional products, which have fallen somewhat out of favor over the last few years, and put them onto a supply chain finance model. And so what we're seeing in the market is huge demand for that outcome. In South Asia, we've signed up now, I think, over a dozen banks onto our platform. I think we're signing banks up faster now than FCI is. So in the region, I think the shift away from the traditional correspondent model to single source, single platform engagement between exporting suppliers in distant markets and large corporates in home markets is something that we're going to see accelerating. And that's been driven, I think, by a triple whammy, which has hit the exporting supplier universe. So what we saw in South Asia in particular is first of all, in the first phase of the pandemic era that we're probably only seeing the beginning of, unfortunately, we obviously saw a lot of orders getting cancelled, and that wasn't just purchase orders for prospective manufacture, that was orders in the factory and even orders on the water. And so we have a whole bunch of factories across South Asia and into China who were expecting cash and then ended up with stock. And of course, they've all borrowed money to make all of that stuff, and that's left them full on their existing banking lines with no cash coming in. And then obviously we had the hiatus in the markets as there was no real activity for 3 months. And now new orders are coming into the market, and buyers now are basically on open account with deferred payment terms. We've seen buyers moving from site LC out to 150-day open account. That's pretty common. And I'm not sure the market and the world has quite understood the liquidity crunch which is hitting the supply chain right now in emerging Asia. It's a triple whammy. They've got the 3 problems, which is the banking lines are still full from Q1 and Q2 from the business that got cancelled. Then they've had no income for a period of time, and now the new orders are coming in, and and buyers are demanding credit. So there's actually a very significant issue hitting the supply chains. The worst affected country that we know well is Bangladesh, where in Bangladesh, they don't grow their own cotton, and they don't have an industrial vertical that generates and builds or makes all the manufactured the man-made material. So they import the raw material for their garment industry, which is their biggest export. And it's actually very, very tough on the ground right now in these emerging export markets, and that's actually why we've invested a significant amount of the last 6 months in getting our supply chain trade finance platform up and running, because these are problems that we all need to fix actually for humanitarian reasons, let alone for socio-economic ones. So I think there are quite tough times ahead, actually, not necessarily in our world, but the consequences of the actions which we're seeing happening on the buyer side over here there are significant outcomes in emerging Asia as a result.
Okay, I think thank you. I mean, that's really interesting, Tim. I think you made 2 really important points. One is that putting supply chain and in fact a lot of trade finance onto platforms makes life easier for everybody. I think we probably all agree with that. But as you were talking, what came into my mind was you're talking of tough times ahead. Just having a slick platform that's better than anything that's gone before doesn't in and of itself produce extra liquidity. How are you dealing with that? Or how do you think the market will deal with that?
To be absolutely honest, I don't know the answer.
Okay, that's an honest answer.
That doesn't mean that I'm not going to volunteer an opinion. Unfortunately, if you know me well, then you'll realize I'm never shy. One of the things I think we're going to see is unsecured credit positions are going to get hit quite hard, because they're the most vulnerable creditor position in any credit stack. And therefore, I can see the market more generally moving to actually favor the relationship lenders and the banks who have maybe secured positions. And that, as Chris has rightly said, large corporates increasingly understand that the supply chain is an asset. It's not just an input cost. It needs to be nurtured, it needs to be protected, it needs to be helped, especially in these kinds of markets. And I can see large corporates using their own financial headroom, as Chris, in fact, Chris, as you said, it's switching dynamic discounting programs which use corporates' own money into funded programs and taking funding from relationship lenders rather than from unsecured capital market sources is probably the way forward. It's reflecting a sort of flight to quality on the buyer side and the need for buyers to invest and protect their supply chains.
Yeah, okay. No, I can see that. Matthew, I should come to you next. A little bit of a mixed picture here we're hearing. So supply chain has the answers once we've dealt with all these little problems that we have that we'll talk about later. But supply chains and supply chain providers have the answers. But the underlying economic health of a lot of people in the supply chain is maybe a little bit rocky. What's your view over at Moody's? How do you see this playing out in international supply chains?
Yeah, look, so far, and maybe to give some overall context through the current pandemic, so far in our, as we call it, global rated universe, the issuers have managed through the crisis surprisingly well. This is also driven by continued high liquidity on capital markets, including access of corporates to bank funding and capital markets, including bond markets. And that has helped companies to manage reasonably well through the financial crisis. We are looking on that from a sector by sector perspective. Obviously, some sectors are affected much worse than others. A few sectors are even considered as winners in the current crisis. But what we are seeing generally is a strong focus on cash of issuers. Many of them remember the challenges through the last financial crisis. Since March, they have worked very closely with their banks in many cases to increase, for example, revolving credit facilities. In many cases, they have experienced that, for example, commercial paper markets remain very liquid and open to them. In many cases, we have seen a bond refinancing and a new bond issuances to keep liquidity alive. And that worked very well. Notwithstanding that, we of course had to downgrade a lot of ratings to reflect the increased challenges, which will remain for a quite long period. As an example, in the automotive industry, where I'm primarily responsible for, we expect that the volumes we had seen at the peak level back in 2018 will come back to the market not sooner than middle of this decade. So the crisis will have a long-lasting effect. But liquidity is there. The difficult thing to analyze in the short run is really, when looking at liquidity, is really working capital movements, including the impact of supply chain financing. What we have observed so far is that liquidity remains robust. A lot of issuers have prepared, especially in the peak of the crisis in March and April, for considerable contraction of working capital and preserving liquidity. At the same time, so far, including having knowledge on developments through end of September now, a lot of issuers have reported that liquidity remains, at least in our rating universe, resilient. The big issuers, highly rated, haven't used that crisis to extend payment terms. Even in the opposite, they continue to pay suppliers on time to leave the supply chain alive. So that works well. But from a rating perspective, and that, Sean, was probably the heart of your question. From a rating perspective, we still have limited knowledge about, or limited disclosure about how supply chain financing impacted working capital movements. And that's a main demand of Moody's, that we are claiming issuers to provide transparency on what exactly they're doing in terms of supply chain financing. There's in many cases some disclosure in terms of annual, but the disclosure in terms of quarterly reports is much poorer. So we are still in the process to analyze exactly how supply chain finance has contributed or distorted liquidity.
Okay, I mean, we'll deal with that in our next subject. But I think, I mean, what you've confirmed is that there is a lot of liquidity amongst the bigger issuers. I mean, these are the people who can go to the bond markets, and what we're hearing from, Chris and Tim, and I think it's something we've always known in the SCF industry, is that done properly, SCF, whether it's through a platform or bilaterally on a non-platform basis, is a great tool for redistributing and reallocating some of that liquidity to the smaller suppliers. And I think that's borne out by what we've been hearing on the growth of bank-funded dynamic discounting, which seems to be the ideal sort of match between bank liquidity and obviously the privileged position of the big buyers and their strategic position in the supply chain. So I know that it's not just Moody's who have had issues about disclosure and transparency. I say we'll deal with that with that next. But I think one of at least the good flip side, if you like, of the liquidity issue is that where there is liquidity, SCF and the platforms does work as a very effective tool for channeling that cash and that finance back into the smaller suppliers. Margrith, at Octet, you have got a slightly different approach, I think, to this market. So tell us, how you've been doing. I think you're maybe not as optimistic as some of the other panelists, but tell us what's been happening at Octet and how you've been seeing the last 6 months.
Thanks, Chris. Yes, it's two roles I would like to share my experience with you. Octet Europe, of course, and also Trade Finance Market. Both are platforms, fintechs, who try to facilitate work for trade, supply chain finance, and make it more transparent and more flexible. I find it interesting that liquidity seems no problem, whereas we, in those two roles I'm playing, find liquidity the biggest issue. We have plenty of transactions, plenty of pipelines, plenty of opportunities. The demand is huge, but the liquidity for those kind of type of finance is lacking. Now, in Octet, we have made a supply chain management platform, which in many ways replaces letters of credits, or could replace letters of credits. It can be used, and this I think is unique, with credit, debit cards, or with funding from banks or funds or whatever is available. You have probably seen in the market, MasterCard has signed a cooperation agreement with Octet Europe and is supporting the use of the cards for B2B trade finance. And I think that's quite unique. I don't think that's in the market anywhere else. But the cards can be used for funding, but of course in a very limited form. And we're looking constantly for funders to help us to extend the terms for these trades. And that's been nearly impossible. I think Chris knows that the trade finance market has also tried with Greensill to find funding. And even Sean, we tried to bring together funding for export of agricultural products from Africa to the trade finance market platform, which has developed a scheme which is called invoice check, which should allow a funder to check that the invoice is genuine, is real, and has not been double funded. And despite all this facilitation, more transparency, we have found it very hard to find liquidity for these transactions in the market. And this has been, in my opinion, the biggest handicap to grow our business the way it could. And I'm interested to hear with Chris and Tim how they see those kind of issues, because we find it very, very hard to get liquidity. Of course, we are small fintechs, but we have unique products which should really help to make funders more happy, more confident, because transparency is there and security is there. It's all blockchain based. And I mean, it's really the latest technology developments, and still funding is very tough to find. And of course, also at adequate rates, that's maybe also one thing one has to add.
Yeah, I mean, there's always, you're a smaller startup. I remember meeting Lex Greensill in the very early days, and he certainly the cash wasn't pouring out of his pockets at that time. But Chris or Tim, how do you react to this? this funding issue. Chris, looks like.
Yeah, look, I think it's some very good points that have been made there. I think, as you said, as we've developed over our 9-year history, we have built a very diversified and robust funding model. We have a whole series of options where we can finance both through dedicated asset managers, through direct bank funding and assignment, through our notes programs. I mean, in 2019, we funded $142 billion worth of assets. So there is certainly liquidity available. I think, to Margrith's point, not always at the cost that we would like, or more importantly, our clients would like. But we use that diversification to try and optimize the value to the clients. And I think one of the important things, particularly when you're looking at supply chain finance, is the suppliers, that cost of funding can still be very, very attractive to them. They are getting fairer finance at rates that is actually normally only available to the larger corporates due to the weight placed on the buyer's credit rating. So I think it is still there. I think it depends how diverse your network can be. It does take time to build up. Would we like to see more liquidity? Absolutely. Was a lot of the liquidity taken away in the bank market by corporates putting in emergency facilities, increasing RCFs, multi-billions? Yes, absolutely, it was. But for well-structured programs, we are still finding liquidity is available.
Yeah, I mean, I would back that from my experiences at SMBC.
I think the problem is still that the SME sector is not as well served. It's always the large buyer who, is on focus, and then indirectly SMEs are benefiting. But if it is both sides, SMEs, like it could be in Octet Europe, then I think you find it very hard to find liquidity. And actually, this is the sector which needs most support, because we all know the SME sector is driving the economies, and the SME sector is suffering the most in the pandemic now, and really needs the support from the global financier industry. And I don't think it's truly happening as it should. And I think governments and supranationals have a role to play. We can probably, as private institutions, not achieve it alone, but we can also contribute with regard to allowing people to have access to platforms which make it really safer and better to fund. And I think it's not used sufficiently.
I agree with you about the role of governments and supranationals, because I don't think there is a market solution, Margrith, to what you're looking for. So when in Prima Dollar's history, we started our history in the SME sector. And I think we found, well, I know we found some very harsh, simple mathematical realities. And I'm afraid these are not realities that are fixed by the blockchain or by transparency or anything else. It's very supply chains. So the negotiation between a buyer and his manufacturing supplier, I'm afraid when they're negotiating the price, they're not pricing in the risk of the credit of the buyer, or the financing risk, or the supply chain risk, or the production risk. In other words, margins in supply chains are pretty well the same, whether you're dealing with small companies or big companies. The margins are the margins. And small companies don't have bigger margins in their supplies, in their production process. If anything, they often have inferior margins, actually. So as a financier sitting here, we're unable to charge the right price for the risk that we're facing. If the margin is 5% in that supply chain, whether it's an SME or a $1 billion manufacturer, that's what we find. The margin is the same. Therefore, you simply can't charge the price you need to accommodate the risk of working with the sector, because the margin isn't there in the supply chain to support it. There's no one to pay the bill. So we pivoted out of the SME sector quite consciously and quite deliberately into the mid-cap and large-cap sector, because the margin is the same. We can charge the same for the money, but the risk is now acceptable. So in a way, I'm not helping, am I? Because I'm kind of telling you that I agree with you.
No, listen, Tim, I think you're right. But it's been, in our experience, not a question of price. It's a question of liquidity being full stop available. I think people are willing to pay a premium even to be able to do what they need to do. And therefore, I think it's really the lack of courage to give funding to these transactions.
Let me stop it there, because I mean, we could go on. It's a long time, and within it, for example, we've had some not very positive experiences with governments. You know, a lot of these COVID support programs have not really looked at trade at all. You know, they've been very locally, domestically focused. But sorry, from that problem, let's go to one that's of equally long standing, but is a bit more technical and actually affects everybody, whether you're emerging markets or first world. And this has been the long-running saga about the accounting treatment of supply chain finance, or reverse factoring, as it's usually called, when the Accountancy Standards Board look at this. So just to bring the viewers up to date, yesterday the Wall Street Journal announced that FASB, which runs responsible for overseeing US GAAP, will be looking at this issue. IFRS, which oversees accountancy standards really for the rest of the world outside of the US, has said that it does not want to take this any further. And because it believes that the existing standards are adequate. What they say is that that there's enough in the existing standards and guidance for companies and auditors to take a view. So in other words, they're not saying that supply chain finance or reverse factoring or payables finance has to be treated one way or the other. This has been, the issue around whether when you bring in a bank into your supply chain to start funding it, you actually change the nature of the debt, because all these debts start out as trade debts, but then are taken over or taken on by a bank. Does that change the nature of the financing? In which case you need to de-recognize and move from trade debt to bank debt. Of course, we've had the experiences with Carillion and Abinger that Matthias has already mentioned, where there was considerable support being given by the buyers to these programs in forms of cash deposits or other security, and they also formed a very large part of their finance stack. So that's and I think just to unpack that also a little bit, there are two issues here, at least two issues. One is about derecognition, as I've mentioned. Do you move from one kind of debt to another? The other one is about presentation of transparency. And this is especially in relation to liquidity, for example, where if the nature of the program will impact liquidity, then there should be at least consideration given to how that's shown in the accounts. Matthias, you've been following this very closely, I'm sure, and you've seen the recent developments. Tell us how you think this should develop, and whether what the accountancy boards have been doing to date has been enough.
Yeah. Look, I mean, the length of your question already indicates the complexity of the overall subject. And I mean, there has been a lot of discussion on that. Moody's also contributed to that. We published an open letter at the 31st of January this year, which was sent to the IFRIC, to the International Financial Reporting Standards Interpretation Committee. And there we asked for additional transparency there, highlighting the challenges we are currently seeing with the existing disclosure requirements, especially when it comes to questions like does supply chain financing have debt-like features? At what point in time financial institutions are involved, and does it have more a debt rather than a liability feature? All of these issues were addressed in our letter, and in essence we were demanding for additional transparency there. Then during the course of the year, and this is something which we think is very positive, there has been a lot of discussion. The IFRS Interpretations Committee has put a spotlight on reverse factoring, and we published a sector comment on the 13th of August this year to summarize these developments. In essence, you are right. The decision so far of the Interpretations Committee has been that the existing requirements of IFRS provide an adequate basis for an entity to determine their presentation of liabilities that are part of reverse factoring arrangements. So the general IFRS standards are appropriate, but that does not mean that all of the issuers are presenting everything as it should be. And I think the spotlight on that discussion remains in place. There will be additional discussions around that, especially not necessarily focusing on the wording of the accounting standards itself, but probably focusing on giving additional guidance on how reverse factoring should be presented and how much disclosure and transparency should be provided. We think that discussion is continuing, and we encouraging that discussion. And again, we are not saying that all companies are providing sufficient transparency on their supply chain financing. I think there's still a lot of improvement, and we are encouraging everyone to be transparent, especially those issuers which are doing supply chain finance for very good reasons. There's no reason to hide it.
No, agreed. And we've seen the very positive benefits during the pandemic. I guess the problem about saying that there's enough already in the existing standards is that you're leaving it open to interpretation. Now there is a little bit of guidance there, and the IFRS decision or statement does say, for example, if you're providing security, extra security, it is essentially changing the nature of the debt. But Chris, I know you've got a strong view on this at Greensill, that debt is debt. But can you unpack that a little bit? So I mentioned there's at least two aspects of this. One is around the technical but very important issue about derecognition. Does a trade debt become a bank debt? The other one is really around transparency, which I think is really what and Matthias has confirmed this, what the rating agencies have been asking for. We really need to know what the source of this is, because it can be withdrawn, for example, because it's provided by banks rather than corporates, and that can change the finance profile of your supply chain. But you could give us your view at Greensill, and if you can, just give us your view on those two different issues.
Yeah, well, I think they're not totally able to be separated, actually, Sean.
Okay.
Anything that increases transparency is something that we are a massive fan of. We've actively called on rating agencies and accounting standard authorities to address that for some time now. Removing some of the negative stigma and negative headlines that does get associated with supply chain finance can only be beneficial for the whole market. There's a lot of debate around, will the existing buyer base who uses supply chain finance be negatively impacted? So to Matthias's point, if they're doing it for the right purposes, they shouldn't be in any way. So having that disclosure of debt, whether it being to a bank or to your suppliers, it's still debt, it's still something you owe, and coming out and disclosing that will reduce that stigma. It will hopefully then unlock the number of buyers who don't use supply chain finance because they don't want the negative connotations, even coming from governments in certain markets surrounding the abuse of smaller suppliers. Again, if it's all open, it's disclosed, then they can't have those arguments anymore, and it could really open up the market. Going back to my opening remark around, I think less than 5% of the total capital trapped within the supply chain is actually funded at the moment. Only 5%, that's really small. If we can stop that and give more stability, everyone knows exactly what the parameters within which they are operating, both from a technical and an accounting point of view, we really believe that that can open up the market quite considerably. So we're all for greater transparency. We think it's really important.
Yeah, and that's been the the view that's been taken by the Global Supply Chain Finance Forum, which is a body that's been set up by the international trade associations, my own, ITFA, ICC, Baft, and FCI. But there should be more transparency. I think the issue around whether that will mean that there's automatic derecognition, which has big implications for, especially for the bigger buyers. I think that is, unfortunately, these two, as you say, Chris, are in some way dependent on each other. Technically, they are separate. And I noticed the FASB were really looking more at the disclosure and transparency requirements rather than the derecognition requirements. But clearly, if rating agencies are going to say with the increased transparency that this is now actually really banked there, then you would have thought that the recharacterization isn't going to be far behind. Tim, is this an issue that worries you?
No, it doesn't worry me because of two things. It doesn't worry me because the benefit for a large corporate of implementing a supply chain finance or supply chain trade finance program is significant. We estimate for some of our clients, we can save them around 2% on the cost of their landed goods by accelerating payments to shipment for exporting suppliers. And accelerating payments to shipment is a capability that you need to have a trade finance backbone for, not something typically done in supply chain finance. But the overall impact and benefit of simplifying the way in which international suppliers are paid and funded and getting payments to them earlier is straight to the bottom line for most large corporates. And so those benefits are irrespective of what the accounting treatment
Absolutely.
is real.
Absolutely.
The second point is a simple one. If trade finance is if effectively a financier, bank or non-bank, is providing an export trade credit facility to a supplier, so the supplier is getting trade credit to him, which he is then using to facilitate his transactions with his large buyer, or wherever the buyer is. And effectively that exporter, that supplier, is a customer of the funder and therefore is subject to the full compliance regime, then that makes complete sense to me that it's trade credit. And I think the dangerous area is where we've got funders who are not treating the suppliers as borrowing customers. If the supplier is a borrowing customer, he needs to be subject to your compliance regime as a lender. He needs to be a customer of yours. If he's not a borrowing customer, then who did you provide the credit to? Must have been the buyer. So it seemed to me that there's a very simple way to decide actually who's getting the credit here. And you can work that out by following the compliance process. Funders who look at this as simply early payment on behalf of a big buyer don't need to do full compliance on these suppliers. They're not my borrowing customers. I'm just making early payments on the instruction of a large buyer. That looks like debt to me for the large buyer. He's the guy getting the credit. If it's the other way around and the funder is saying, well, actually, all of these suppliers are in fact my borrowing customers, I'm providing facilities to them, which they then choose to use in support of their trade with the big buyer, sounds to me like that's trade credit. And it seems to me that there's a very simple angle there, which accounting authorities could use to decide who's getting the credit facility then. And the compliance process generally tells you who's getting the credit facility. Did I make that point clearly enough? I mean, I think.
Yeah, no, you made it very clear. It's not a point that's been made by anyone. So that's a very interesting way of looking at it. I did to pick up the first point. Of course, we shouldn't forget that for many buyers and suppliers, this question is a sort of a technical irrelevance. What they need is the supply to funds at the better rates that supply chain offers. But yeah, your second one, I think you need to go and speak to FASB, Tim. You're the man with a solution here.
Sean, there is a more fundamental point about supply chain finance. I don't want to use up all the oxygen in the discussion, so cut me off if I ramble too much. But getting in any supply chain, there's a liquidity requirement from the date of the purchase order all the way to the date when the goods are turned into money by whoever is receiving them. And that's a working capital requirement. And that's divided into two phases. There's a supplier side phase, which is full of supplier side risk. Is he going to make the right stuff in time? And then there's a buyer side risk. Is he going to pay for it? And effectively, the inefficiency in financing this supply chain comes when payment is coming late, which means a supplier side funder is now facing buyer side risk. And that is actually where the expense comes. And in emerging markets, it's an extreme situation. You've got a local bank lending money for the making of a product. And he's then being asked to take a payment risk on a buyer that's potentially in another continent. And of course, he doesn't know how to price that risk. And the guy who's paying that price is the supplier. So when you don't have pre-shipment financing joined up properly with post-shipment financing, that's actually where most of the cost is sitting. And the key trick then is to join up these two pieces, post-shipment and pre-shipment, so that they work well together, which means that the local lenders doing the pre-shipment are not exposed to the buyer side risks. And that's actually where the cost saving comes. It's not just about funding rates. It's not just saying buyers got cheaper money. It's bringing the buyer side risks and taking them away from the supplier side of the process.
No, that's well understood, Tim. And I think you brought us on very well to the last subject that I want to talk about, which is how technology. We've talked about here about the supply chain platforms, about how that actually can solve the problem that you've mentioned. Well, actually, the question I want to ask you is that can they solve this problem at scale globally? Exactly the problem that Tim has mentioned, with exactly the consequences that Tim has described so well. Margrith, you are the most fintech, I think, of all the panelists. Is the future all digital? Is it going to provide all the answers and solve Tim's problems? In fact, that was Tim's problems, but the problems for sellers in emerging markets.
Yes, I think it does. And if you're looking at Octet Australia, which is our franchise owner, it has worked extremely well for exports from China into Australia and other Asian countries, and vice versa. And I think it has removed substantially the risks and the issues attached, because these buyers and sellers are approving directly their own situation. So there is, and there is live transparency on the transactions from pre-shipment to payment. And I think these technologies can definitely remove substantial risks in this environment. And Australia, of course, also funds these transactions, and the experience has been extraordinarily positive. And we're talking here countries like exports or imports, Bangladesh, Pakistan, China, Indonesia, the Philippines, mainly Asia, because they have focused on that. Now, of course, Octet Europe will try to bring the European angle to it. And our sister company in Turkey, also very successful with bringing Turkey into this global environment. And I think the technologies, they don't remove 100% of the risk. There will always be some risks left, but they remove them substantially. And I think they really help buyers, sellers, and funders to do these transactions more easily. And I could not agree more with Tim on the fact that if it's trade finance we provide, there should be no issues for the regulatory applications. The question is, are we doing trade finance or are we just lending secured? And I think many don't distinct that very clearly. And that's where the issues come up. And of course, Tim is right. If you look at all the suppliers and do the compliance and issues with the suppliers, then I think the situation is much clearer. But I'm afraid most are only looking at the buyer, the big buyer, and the suppliers are not important. And that's where the issues come about from an accounting point of view. But that's not addressing really the issues for the supply chain platforms, the digitalization. I think that has little to do with that, except of course that the platforms can facilitate the compliance issues and the transparency, but not the accounting issues. I think that is a totally different subject in my opinion. And if a platform does not do all the due diligence on all the suppliers and all the buyers, it might actually be just providing debt. Yeah. But I think platforms tend not to do that because regulations are such, at least in our case, we have to do full compliance on buyers and sellers. And that already resolves some of these questions.
Yeah, I mean, the line of sight, certainly that platforms provide is quite tremendous and wasn't there before. On top of that, of course, you can add now a lot of utilities. You know, I'm thinking of the KYC utilities that can be sort of plugged in quite well. Chris, you've mentioned, you know, the use of AI and the fact that you've got a sort of a pretty variegated approach to funding and to the way you also structure. Are we going to see a green sill, a single all-encompassing green sill platform, or will the market see that? Will it be one or a couple of platforms? How do you see, because there are dangers, of course, with what's called platformization. It's on the one hand, it's great. On the other hand, you could get into a situation where you've got only one or two you know, big platforms that are pushing everybody else out. How do you see this evolving from a green sill point of view?
It's a really good question, Sean. I mean, we use and cooperate with a number of partners, as well as doing things using our own rails as well. So we definitely see the benefits of having competition, different levels of development into the market, not just for the technological development that can take place when it's not just in one or two specific platforms, but also just the benefit for the supplier base and the customer base, having that choice. Different people want different things from their programs, and different platforms provide different things. What we are seeing is, from Greensill's perspective, we are constantly looking at ways of innovating, to Tim's point, of finding different parts of supply chains and working capital that aren't being financed at the moment. One of the big projects we've launched and is being very successful is our earned product, which is actually looking at people's own supply chain finance or supplier base, whereby as an employee you get paid on day 30, but you've actually earned that money. That is, you're providing your goods and services for 30 days before you get paid it. So we've now launched an app where people at the end of the working day can actually draw down a percentage of their salary that they have earned already. So that type of innovation, going out, working with corporates as opposed to the individuals, the motivation behind that is to drive out payday lenders, which we very much do not like. Most people don't. We've rolled that out with the NHS again initially, so all of the nurses in the COVID time have that ability to draw down on their pay. It's very good for mental health. It's not just about financial benefits as well. So what we're seeing is development of different solutions within our own platforms targeted at different client bases. Again, we're working with Tim on the things around the shipping space as well. We see a lot of interest in intermodal trade finance and what can be done in those aspects and developing platforms around that as well. So I think it's taking the concept of working capital, of supply chain, working with our partners, both from a distribution, from a technology perspective and origination perspective, to put together solutions so that we can end up developing that end-to-end sort of soup to nuts for each of the clients in their whole supply chain, not just as it is at the moment, fragmented parts of it.
Okay, so I mean, if I've understood you, it's different platforms or applications for different markets, and even within the global trade finance markets, there are sub-markets there, of course. Matthias, how do you? I'll just finish with you just very quickly. How do is this increasing digitization a source of a positive thing from the rating agency's point of view, or are you fairly neutral on it? Maybe take up a little bit Margrith's point about transparency, recognizing that it's not the same thing as the accounting issue, but of course does help.
Look, I mean, we don't have a very firm view on that, but I think generally digitization is positive because it makes data quicker available, and it helps basically also corporates to gather all relevant data in a more timely manner, and in the end be able or be in a position to communicate the outcome in terms of their financial statements to all of their stakeholders, including bankers as well as rating agencies. So that's the general expectation that digitalization is something which is generally helpful for and also supportive to their financial communication and transparency.
Good. Tim? No.
So, and I think part of this is also leading down to what data we're talking about. And one of the main limitations of supply chain finance is that the only information circulating typically within the systems is the invoice. And Sean, you'll know that very well, that in fact, if you want to do in trade finance, actually, compliance is much less about who you're dealing with, much more about what you're dealing with. So the main risks in trade finance typically are in the transactions, not in the people. And the regulators require us, for example, to check the vessels and to check the vessel routings and to substantiate the arm's length market value of the products that are being moved, to ensure we're detecting layering of cash into transactions. And the compliance overhead in a trade finance model requires a significantly different set of information, which is typically not available in a supply chain finance platform. And that's where trade finance starts to come in, and the merger of trade finance and supply chain finance, which is what our platform is all about. Because we're tracking bills of lading, packing lists, we're scraping the bills of lading to take the vessels off, and hooking into maritime APIs to see where the vessels actually are. And we're able to do that with tech in a very real-time way. And so it's not so, yeah, you're absolutely right in terms of the transparency, but for me, the transparency goes to the heart of our ability actually to do these transactions at all, while still complying with the requirements of the regulators to know where the stuff is, what it is, and that it's being traded at a sensible price. And actually the dimensional differences between effectively the two-dimensional world of a supply chain finance platform, which is chasing an invoice around, and the three-dimensional world of trade finance, which is very much aimed at payment before delivery, payment at shipment rather than payment at delivery or later. The dimensional problems are significant, and that's where tech really starts to become very relevant. And where we've placed all our technology investment is into making those environments work and harvesting these much greater data sets that you need to extend supply chain finance into emerging markets. So the fintech has got a huge role to play here.
Absolutely, I totally agree with that. I guess the only negative side, and being a lawyer, of course, I always see sometimes the negative side of things, is that the more data you have, the more you're expected to do with it. And I've always found that one of the slightly unfair aspects of of the regulators, or attitude of the regulators, is that, look, you've got a lot of data, you can find out a lot, and as you say, there is that data, but you do need to analyze it, and that is an investment, but it's an investment that's increasingly affordable. Thank you, look, all of you. Sorry, Margrith, ladies, last word to the lady then.
No, I really like what Tim was alerting to, because I think that's exactly what the platforms need to do, to check the underlying transaction. And I think that's what many don't do. Octet does, because that's exactly the role we're playing, to make sure that all the information on the transaction are right, correct, and make sense. So it's truly trade finance. But I wanted to maybe ask a question to maybe Chris and Tim, whether more consolidation in all this platform digitalization isn't required. Because I think in the interest of the users, buyers and sellers, there must be a lot of confusion now, and maybe there is a need to initiate a little bit more consolidation and working together. It's maybe also something for ITFA, I don't know, to tackle, because I think too differentiated can also be negative for our industry.
Yeah. Well, I mean, I'll ask Chris and Tim just to quickly respond. I mean, from a military perspective, I think we are keen in having a very rich environment of fintechs, because they do specialized jobs. Chris, so your view quickly. Consolidation, good thing or bad thing?
It's probably one I'll leave to my chief exec, to be honest, Sean, but
Okay.
There's positives and negatives of each of these.
Yeah, that's right.
The competition is great, but having, to Margaret's point, too disparate, too small, I don't think that benefits anyone. So having sufficient scale is important, but it's about the provision of the underlying service being appropriate for the market. And as long as that is occurring and people aren't sitting still but growing, whether that be organically or through acquisition, I think that's a key focus that the company should have.
Okay, Tim?
Well, I think consolidation will happen, because there are a lot of subscale businesses in the platform space that are not profitable. And unfortunately, the current market conditions may well shake that down. And that doesn't necessarily mean that there's a happy exit for everybody either. It means that we're moving into pretty tough times. We are in tough times. Tough times, I think, are going to continue. It's going to take very wise and smart people to navigate all of this successfully and continue the pace of innovation. Margaret's absolutely right. In the end, the market will start to coalesce around a number. It might be as many as 10, but a number of successful platforms with global reach. That'll be where we'll end up at some point.
Okay, thank you, everybody.
Where with lots of horses in it, and where lots of people can still win, but not everybody.
Absolutely, and different markets and different specialisms. So I think I agree with that. All right, I think we'll leave it there. Thank you to all of you, to Margrith, Chris, Tim, and Matthias. Thank you for being on this very interesting panel and for having spoken so honestly and intelligently. So thank you. I think we'll close it there.